Good morning, good afternoon, good evening, depending on the time that you are watching this. My name is Mike Molina. I'm with Highlands Residential Mortgage, NMLS number 1857587, the team leader for Mike Molina team. And today I want to talk to you about buying a home from family with no money out of pocket. Okay, there's a few things that come with this. This concept is known as a gift of equity. So we're going to jump right into it. In order to accomplish this, you will have to buy it from a close family member. So a brother, a sister, a mom, a dad, grandma, grandpa. Pretty much it has to be close family. There are very few exceptions that comes from extended family. If you're looking at maybe a cousin or a stepbrother, it has to, I guess, make sense for the underwriter depending on the company you're doing this gift of equity with. But you do have to have some sort of history with that person, right? It's not like, hey, that's my cousin. We never, we're family, but we never really grew up together. We haven't seen each other in years. You're not going to be able to get that gift of equity with that because you got to think of it. You may know the concept of basically getting a gift of cash for your down payment on an existing home, right? Maybe you don't know who that seller is, but you're only able to get that gift of cash from close family, right? Brother, sister, mother. So this is the same concept, except they have the property and they're giving you that property. And the way that you're getting it gifted is through the equity amount that they have on there, whatever's left over. Now, this is for a transfer of ownership. Okay, if you're just going to be added onto title, you might as well just do a refinance if that person's still going to be part owner of that property. So let's say it's your mom who's gifting you the property, but she's just basically adding you onto the title, just in case, whenever she passes, you're still going to be with title and you don't have to do that refinance. That's a completely different story. Or sorry, not the refinance, but the transfer of ownership. That's a completely different story than what we're trying to accomplish here, which is basically a transfer of ownership. So it would be mom saying, hey, I'm moving to a new property. I'm going to sell this property that I have to you so that, I can leave you something. Then at that point, that's going to be considered a gift of equity. The benefit of this is that you're coming in with no money down. Okay, you usually do not come out with anything out of pocket, but it does depend on the equity that's in that property. And usually you get these properties because it's close family below market value. So that property could be worth 400,000 and they're giving it to you for about 350. You'll be able to accomplish that as well. And it depends on how nice that family member wants to be, right? Because they could easily just put it on the market and get a little bit more money for it. That's that conversation that you would have with that family member. And this can be done with them having an existing mortgage on their property. Okay, the property does not have to be what we call free and clear. Basically, there's no liens on that property. They can still have an existing mortgage. Now, of course, that mortgage will have to be paid at closing, whatever they owe. So in that example, let's say that property is worth 400,000. They owe $200,000 on their mortgage, and they want to sell it to you for 350. So in that case, they're going to pay off that loan at closing. They're going to net $150,000. You're still going to get that property at below market value. It's a win-win situation for everybody. Now, you do still have to qualify for the payment on that loan, right? It's basically you're taking out a loan and you're going to be making those payments on it. So you will have to qualify in this scenario at that $350,000 purchase price. Let's say you would still have to qualify for the payment at that price point, depending on what that current market rate is. You'll be still paying principal and interest, homeowners insurance, property taxes, and maybe even mortgage insurance, depending on how you want to structure that. And we'll kind of jump into that. So this option, this gift of equity option, you actually do have the option of not having mortgage insurance, but it does depend on how much equity, right? We're going to go back to that equity conversation that we have. So if we're doing, where that property is worth 400,000 and they want 350, you may not have enough equity in there to do 20% down to remove that mortgage insurance and not have it on there if we're going conventional, right? But now let's say that same scenario where that property is worth, 400 and let's say $50,000, and they're going to give it to you for 300,000. Now, technically, you'll be able to do 20% down. 20% of that property is $60,000, so you would put that as your down payment. Now, if we're doing conventional, you technically won't have mortgage insurance. So that would be the benefit as well. You're not coming in with 20%. That's not coming out of your pocket, but that is going to be put into that equity of that home. So now at that point, that mortgage may now be not 300,000 because that's what that purchase price is, and maybe a little bit more, 360. because you're putting in that 20% down theoretically, right? When we're talking about those higher down payments, it does get a little bit more tricky, right? So we'll start off with just pretty much generic numbers just to make this a little bit easy. Let's say that purchase price is $300,000, right? That property is worth $400,000, and you qualify for an FHA loan of $300,000, right? Or let's say 325 is pretty much where you're going to want to be. 325, 330 if that purchase price is 300, and I'll explain why. So that purchase price is 300,000. Okay, that is what the seller, in this case, mom, dad, sister, brother, is going to be receiving for the sale of that property. But now we have to consider down payment and closing costs, right? Down payment, let's say it's an FHA loan, 3.5% down. You're talking about $10,500 plus whatever those closing costs are. Let's say it's another $10,500. Just to make the math easy, that may not be accurate. So it's just to kind of give you guys the perspective of how it would work, right? So that would be $21,000 all in. So now you would have to be at 321,000 is what your loan's going to be, right? Because you're considering that purchase price of 300, that's what the seller's getting, but then that $21,000 is going to go back into the loan at that time. So you would have to actually put your purchase contract at $321,000, okay? Because the underwriter is only going to consider the lesser of the sales price or that appraised value. Okay, this is not a refinance where you're going to be able to mess with those numbers. It's going to have to be on that purchase contract because it is a transfer of ownership. So we'll say that purchase contract is going to say $321,000. So the underwriter is going to go based off of that purchase price, even if the appraised value is much higher. So the seller already knows, okay, I'm netting $300,000. That extra $21,000 is going to go towards your down payment and your closing costs. That's going to get put right back into the loan. And if that property value is still worth $400,000, you're coming in with $79,000 in equity. Okay, that's pretty much that basic concept of how that works. And you would be able to do the same thing if you were doing 20% down. But it all depends on that equity, okay? Just like a refinance, it depends on that appraised value, how you're going to be able to maneuver that, you know, and the equity that you have in that home. If you're going to be able to do 10, 15, 20% down, you can theoretically push all the way up to whatever that appraised value is going to be, right? Let's say, same thing, seller wants 300,000, mom, dad wants 300,000, property's worth 400,000. You can technically buy the property at 400,000. That extra $100,000 you can use towards down payment, closing costs, paying down the rate, whatever the case is, because they've already told you, hey, we're okay with 300,000. So that extra 100 that's left over in this example, you'll be able to utilize for any sort of down payment, closing costs. You know, if rates are high, if you're right below the actual approval range that you need to be, then you can lower down the payment to be able to get the rate to be able to get you to qualify. So different things like that, different strategies. The point is that you will not have to come in out of pocket with any sort of down payment or closing costs, as long as there's equity after they're done paying off their mortgage, after whatever profits they want to receive from that. So that's that conversation you have with that, you know, with mom, dad up front. You know, if you're doing it with a with a bank or another lender, you want whoever that loan officer is going to be helping you to guide both you and that seller, you know, that close family member, to say, hey, you know, what is it that you actually owe on this property? How much are you trying to get any sort of profit back? Do you want to just, you know, pay it off? Different conversations like that, so that they know, okay, well, the best bet would be, you know, doing it at $350 if you want to net $20,000, because that extra other $30,000 from that $300 will be considered for down payment and closing costs. So different structuring like that. But this is a concept. This is done all the time. We do these gift of equities pretty frequently, especially now recently. You know, the easy thing is that people want cash in their pockets. They want to give their property over to, you know, they want to either give it to their grandsons or their sons or daughters, and so on and so forth. So gift of equity is actually really, really popular, and it's very, very good for both the seller and the buyer. The seller's going to be giving that property to someone that they know is going to take care of it. That is, you know, if it's, you know, your son or your daughter, you're transferring that ownership down to them, but without the responsibility of being on that mortgage or on that title for the seller, and you'll still be able to net whatever profit you want. And then for the buyer, you're typically coming in with a property that was gifted to you, and usually, most cases, below market value. It's not always the case, but usually, you know, it is, depending on that conversation you have with your parent. Thank you so much. Once again, my name is Mike Molina. If you have any questions, concerns, you can always reach us at 786-265-8622. Until next time.